save this if you guys want me to. Save it. If you don't want me to, it's okay too. But just starting out, a couple things administratively. You may have seen on Canvas in the gradebook, if you haven't been watching the last day or so, I've started entering points in for homework and quizzes. Again, if you're missing class dates, you're not showing up, and I'm usually preaching to the choir of people that are on time and in attendance. If you're missing class dates, you're missing quizzes and homework, you're seeing a 0 in there for those dates that you missed, and I just go by the attendance sheet. So if you weren't here for a particular day that we covered that material, you get a 0 for the quiz, you get a 0 for the homework. And it's not a big deal if you miss one or something, because I think it's something like 1.5 for 3 points or something stupid like that. Big deal. But if you start missing a string of classes, it's 3 points, it's 4.5 points, it's 6 points, and I've had students follow me out to my car trying to get 6 points back on a quiz before, to just go ahead and sacrifice, 6 points by not coming to class is, to me, a little bit silly. So maybe, because we're starting to get a thin attendance, maybe everybody's dropping the class. If that's the case, fine. But if you're planning to stay in the class, I highly recommend you watch your attendance and make sure you sign in. In terms of our quiz, which is supposed to happen next week, I mean, we're getting pretty far behind. Our options would be to just have 2 chapters or 3 chapters on the exam. Maybe we can squeeze in chapter 8 before the 7th, which is a week from today, Wednesday, right? Is that a week from today? Huh? Today's Monday, so almost a little over a week from today. Okay, or we could, a week from Wednesday, or we could push it back to after Veterans Day, I guess. The only problem there is, we'd have to we would do chapter probably 5, 7, and 8 for sure. Probably not 9, but maybe 9. But then that would push us into having to put chapter 9 after the break, and therefore on the final. So we'd have more chapters on the final. We'd have 11, 12. We'd have 11, 12, and 10, 11, 12, and 9. We'd have 4 chapters on the final, but we'd have to kind of squeeze those in with Thanksgiving break squeezed in there in the middle of that. What do you want to do? I don't care. Well, that would be the best of both worlds. That's not happening. Yeah, okay, I see what you're saying. Yeah, that could happen. Yeah, less chapters on the final, and I see what you're saying. Sorry. Yeah, and delay. Well, I don't know. Let's hear the argument against. Is there? Um, I mean, I guess we could do the 19th, but I don't know that's starting to really get us behind the 8 ball. Huh? Yeah, I don't know that's. I mean, I understand what you guys are saying, but I mean, we're having a problem with time to cover everything. Okay, and maybe my timing should be a lot better, but it is what it is. I mean, I want to cover the material. I don't want to rush through the material. And so I'm trying to figure out how to cover everything that's in these chapters without squeezing too much in towards the end. So right now, the one objection is that we've got a conflict for somebody. And I understand that. I mean, I understand that, and you've been in good attendance and blah, blah. And if it was somebody that wasn't here half the time, I might be a little different about it. But well, I'll tell you what, let me sleep on it while I'm lecturing the class. I'm going to put it in the back of my brain, and let's talk about it at the end. Let's kind of let that marinate a little bit, and we'll revisit it here at the end of class, because I do want to make a decision on that. Okay, so in the meantime, let's head over to chapter 7. And if you're just coming in, in terms of resources now on Canvas, just so you know where these things are coming from. Chapter 7, you have the slides, you have the quiz. Let's see how far we can get on these two documents today. That might make a big difference as to where we think we can go with the exam dates and stuff. Okay, so let's just jump in to chapter 7. And if you haven't noticed, now we're sort of done with the income statement. We talked about income statement in chapter 4. We talked about revenue recognition in chapter 5. So we're now turning to our previously neglected balance sheet, right? And we're going to start with our more liquid asset, cash, and receivables. Now, we talked a little bit, I think it was in chapter 3, when we talked about the elements of the financial reports, the definition of cash. Cash is obviously, and you can see some of these obvious things here, coin, checking accounts, savings accounts, money market funds, deposits held as compensating balances against borrowing that is not legally restricted will still be seen as a cash and a cash equivalent. And then remember, we had our discussion of cash equivalents, and we talked about treasury bills, certificate of deposits having original maturity of 90 days or less, and we had talked about that back in chapter 3. And we had a couple questions. I think there was even some on the midterm that dealt with that notion. I won't be repeating that for midterm 2, but I just want to remind you what we had talked about then. Okay. Now you come over, and when we look at our cash, cash can be restricted or unrestricted. Okay. Now if cash is unrestricted, it is automatically going to be seen as a current asset. Okay, so if we have unrestricted cash, you can even write that next to it. Just put that it is unrestricted. Unrestricted cash, I should say that it is automatically a current asset. Unrestricted cash automatically is considered a current asset. Now, when we look at our restricted cash, whether we carry that cash as a current asset or non-current is going to be predicated on the restriction. And you can see here that if the restriction is for some sort of current asset or current liability, for example, we're putting money aside because we want to pay off a liability that's going to come due in the next year or so, then that cash is going to be considered current. If we're restricting the cash, setting aside a cash because we want to purchase, say, inventory, then that is going to be considered, that restricted cash will be considered a current asset because we're setting it aside for the purchase of a current asset. Okay? If, though, the restriction is associated with a non-current asset, a non-current liability, now we're setting cash aside because we have a bond principal that is coming due, say, in the next couple of years, and we want to start setting up a sinking fund so that that money will be available to pay that interest when it comes due, then that cash is considered non-current. So cash, which you're used to thinking as a current asset, if there is some sort of restriction on it, you need to look to see what the restriction is for. So unrestricted cash, cash is automatically considered current asset. If there's restricted cash, you have to ask yourself, is that restriction for a non-current or current purpose? If the restriction is for a non-current purpose, then the cash is still going to be what? Is going to end up, I should say, being non-current. If the restriction is for a current purpose, then the cash will be current as it always is. Okay? Okay, good. So they give us some examples of restrictions, and they tell us that we could have cash being restricted because there's some sort of financing agreement with a credit institution as a compensating balance. That would be consideration of restricted cash, and we have to put the label restricted on the balance sheet. Okay? All right, good. Now we have bank overdrafts. We bounce checks. If an entity bounces checks, those are to be reported as a liability on the balance sheet. Okay, sometimes the sense is you have cash at two different banks, and one bank account is overdrawn, the other one isn't, so you want to net those two together and just report the cash net of the overdrawn amount. No, the overdrawn account would be reported as a liability because what? It's a different entity, isn't it? And so since it's a different entity, that cash is going to be a liability. If, however, there was an overdrawn amount at you have two accounts at one bank, two different accounts at one bank, and you have overdrawn on one account but not the other, then you can net them. But if it's two different institutions, say Bank of America and Wells Fargo, and you have an overdraft at one of those, the overdraft at that one needs to be shown as a liability on the balance sheet. It's a liability. Okay? Okay, good. Let's take a look at this exercise here where we have this company that has their cash ledger balance at $160,000. Okay, and when you look at this, this is really more or less a timing exercise. The question is, we have this $160,000 cash balance, and we want to see if these items, based on their timing, should be included in this or excluded from this total amount. So they have the following items in their safe, and it's a $5,000 check, payable to Smith, dated January 2nd, year 8, and it was not included in the December 31st checkbook balance. Should it have been? It should not have been because it's dated what? Year 8, so it's not year 7 money, right? So that's something we're just going to ignore. We're not going to have to adjust for that at all. Okay? Okay, good. You look at the next one, and we have a $3,500 check payable to Smith, deposited December 22nd and included in the December 31st checkbook balance, so it's included in that $160,000, which was returned non-sufficient funds. The check was redeposited and didn't clear until year 8. Should it be included in the year 7 money? It should not. So you can see that they went ahead and did what? They subtracted out that $3,500 here. It should not be included in the year 7 balance because we really didn't clear the bank on that until what? Year 8, right? Okay. Then we have a $25,000 check payable to a supplier and drawn on Smith's account, meaning that it was subtracted from the $160,000. That's what that means when it says drawn on Smith's account, and was dated and recorded December 31st, but not mailed until January 15th, year 8. We need to do what with that? We need to add that back because they had not mailed it until January 8th, so there was no way that it needed to be subtracted from the cash balance during any time during year 7, right? Because they didn't mail it till the next year. So we add that one back. Okay? Okay, good. Come over and let's take a look at bank reconciliations. Okay, and what we basically going to have here is just a simple reconciliation, and the key word here is simple. Okay, if you've ever had a bank account, you have probably done a reconciliation, something like this, or you maybe even saw it in accounting, business 20, accounting 100, whatever. But let's just remind ourselves of how we do the bank reconciliation. Okay. Now, when you look, there are these different terms that you've probably seen before. Deposit in transit means that what? That we have a deposit that we made towards the end of the year, and it hasn't been reflected in the year-end bank balance because they didn't receive that deposit by the end of the year. So even though we had that money at 12/31, it's recorded in our books, the bank didn't know about that money until what? Say January of the next year. You have outstanding checks. Outstanding checks are amounts that we've written against our bank account, so we've subtracted it on the books, but it hasn't cleared the bank yet, so the bank balance isn't showing that. You have service charge. Service charge is basically what the bank is charging us for having the account or whatever, and we're probably going to find out about that when we finally open up our bank statement. Bank collections. Banks can make collections on our behalf. That is often a internal control in which we will have a lockbox function. Lockbox function is where our customers do what? They send payments to us directly to the bank. They don't send them to our place of business where our employees might open those up and be tempted to try to steal those or pilfer those, intercept those somehow. So it goes straight to the bank, and the bank informs us when they've collected money from our customers on our behalf. That's an internal control function that many, many companies use. Federal government, I was on an assignment where we looked at the lockbox function where the federal government has federal tax deposits that are sent directly to banks that they contract with. The one that we were looking at was Bank of America. Congress had us looking at that because people were sending in their returns with their checks to pay, and the bank lockboxes were having trouble keeping up with their quota. And so not Bank of America, but other banks around the country, a couple banks started shredding the returns and the checks because they couldn't keep up with the quota. And Congress didn't think that was too cute that checks that were headed to the Treasury were being shredded. Taxpayers were calling in, "Where's my check? I sent it in." And they found out that they were shredding them at the lockbox. But these are huge facilities. I mean, giant like warehouses where they process all those checks using fiber optics and stuff. And so the bank will inform us when they make that collection on our behalf. Errors, either side can make an error. Either the bank can make an error or the company can make an error. Non-sufficient funds, we generally find out that somebody gave us a check and did what? Didn't have the funds to cover it, so the check bounced. Not a check we wrote, but a check that someone wrote to us. And then sometimes interest income, we'll look at what the bank tells us about that interest income, but often we'll recalculate our own interest income to see that it's the right amount. Okay? So the way to look at these items is to ask yourself, who knew about it first? Did the company know about it first, or did the bank know about it first, right? And that will determine what adjustment you'll make. So deposit in transit, company knows about it first, you adjust the bank balance, right? Outstanding checks, company knows about it first, adjust the bank balance. Service charge, the bank knows about it first, so adjust the book balance. Bank collections, the bank knows about that first, adjust the book balance. Depends on who made the error. Can banks make errors? They absolutely do. You got to keep your eye on them. Non-sufficient funds, usually the bank knows about that first, address the book balance. And interest income, again, the bank reports that on the bank statement, and you can sort of make an adjustment based on what the bank calculates, but there should be a recalculation of your interest income just to make sure that you're satisfied the way the bank calculated that. Okay? Okay, good. So let's just look at this real easy example here. And we've got information in that our company records indicate that the cash balance is $12,560. Meanwhile, we sit here and we get a bank statement, and the bank statement says that our cash balance is $10,050. Now, there's obviously a discrepancy there. We're going to try to figure out what the correct bank balance is. They tell us of what? A bank service charge and an NSF check. These are things that the bank would know about first, that the company would be making adjustments for, and then we have what? We have this information that the company knows about. Obviously, the balance per books the company knows about, but deposit in transit and outstanding checks. Okay, so what do? We go ahead and we start out with the company
balance per books, and then we make adjustments for these things that the bank knew about that we knew about that the bank did not, which is what? We make adjustments for things that the bank knew about that we did not. I'm going to make those green, I guess. So what happens? We go ahead and we take out the bank service charge. We take out the NSF check. That's a total of 100. And that's the adjusted, and we're pretty much saying that's the correct cash balance, right? But then we go ahead and we pick up what the bank said the bank balance was, and we're going to adjust it for things that the company knew about that the bank did not. So we pick up that bank balance of 10,050 right here, and then we add these deposits in transit, okay, which were what, 3,000, excuse me, and we subtract out what? The outstanding checks of 500, and the thing reconciles, doesn't it? Okay, and it's supposed to reconcile. Okay, simple bank reconciliation, guys. Like I told you, the operative word there is simple, right? Okay. Okay, good. Now we come over and we talk about accounts receivable. And when we talk about accounts receivable or receivables, we'll talk about them in terms of our trade receivables, which is basically when we are selling merchandise and we're going to let people pay us over time, versus our notes receivable, which is basically probably a longer term, more formal receivable. And it could be for sale of merchandise, could be just a straight up loan that we're giving to somebody. Okay, and we'll see how we're going to calculate those. Usually there's going to be interest income associated with those, and we'll see how we'll figure that out here as we go through some of the slides here. But let's talk about accounts. We also have non-trade receivables as well. Dividends payable, that dividends receivable, I should say, interest receivable, deposits in banks, etc. We're going to pretty much deal with these, the trade receivables. Okay. All right. So let's just go ahead and take a look at the valuation of our accounts receivable when we're offering a discount on our goods. Okay, we're going to see here that there are essentially two methods. One is called the gross method. The other one is called the net method. Now what happens? When we look at these, we will have a discount, and the discounts are often talked about in terms 210 net 30, which I'm sure you've seen before. That means we have a 2% discount if we pay within 10 days. Otherwise, we have to pay the full amount in what? 30 days, okay? 210 net 30. Now, there are two ways to deal with these discounts. One is the gross method. The other one is going to be the net method. Now, let's look at the gross method first. That one's a little easier. They're both easy, but let's look at the gross method first. And when we're looking at gross method, we're going to go ahead and record, and notice it's 100,000 of sales, terms 210 net 30. And under the gross method, we just assume that our customer is not going to take the discount. So we go ahead and we debit the account receivable, credit the cash, and then what? If the person takes the discount, then we go ahead and we will, of course, debit the cash net of the discount because they're only give us 98,000. We credit the receivable for 100,000 because now we're not expecting any more money from us. They've paid us, and we're going to have the sales discounts taken of 2,000. Now, when we prepare our income statement a little bit later, we'll show, I'm going to write it over here, I guess. We're going to show sales. And we'll show sales of what? Where'd my sales go? Yeah, thank you. Yeah, there's a typo there. I'm thinking, where the heck did my sales go? And they forgot the sales. It's a debit to accounts receivable and a credit to sales, right? Okay, thank you. So my sales is going to be what, 100,000? Okay, but then I'm going to go ahead and I'm going to report the sales discounts. So it'll be less sales discounts. And the sales discount is how much? 2,000 here? So I'll report on the income statement net sales, and obviously the net sales is going to be 98,000. Okay. All right, so that net sales of 98,000 now is reflecting actually the amount of cash I got on this deal in the end, isn't it? Okay. Now that is going to be the net method. A lot of times, guys, you'll see on an income statement they'll just start with net sales. They don't always break it out like that for you and show you the discounts, show you returns. They'll just talk about net sales. Okay. Now, if they don't take advantage of the discount, then we can go ahead and simply do what? Simply debit the cash and credit the account receivable for the 100,000 gross that we set it up. And we use the gross method if we pretty much expect that people aren't going to take the discount. Okay. Now, if you use the net method is going to be recording the original sale, and again it's a debit to accounts receivable, credit to sales, for the net amount 98,000. Now if they pay us within the discount period, we simply debit the cash, credit the account receivable. If we do not receive the money within the discount period, they're obviously going to pay us the full 100,000 cash. We'll credit the account receivable, and then we can go ahead and credit an account called sales discounts not taken. That sales discounts not taken, typically what we do is we just simply close that out to sales. So at the end of the period, we'll debit sales discounts not taken and credit the sale so that our sales come up. Okay. Okay, so gross method, net method for recording our discounts. Okay, all right, right of return. What happens here? We talked about this actually in Chapter 5. If we have a right of return that exists, we're literally going to have to establish a liability for the amount of our estimated returns. So this same slide I picked up from Chapter 5 because we talked about it in there, in which we have these sales. We go ahead and we debit cash for the amount of the sale, credit the sales revenue for the amount of sales, and what are they estimating here? I forget the percentage was what? 5%? Was going to come back? Was that what it was? So we went ahead. Oh, it's hello. It's right there. So we go ahead and we debit sales returns and credit refund liability. Now, sales returns then will be reported on the income statement as a subtract from our sales. Notice, guys, this is an estimate. We don't know what they're actually going to return, but we actually reduce our sales by the amount we think are going to be returned. And remember, we said last time that we will reduce our cost of goods sold for the return, and we will also do what? We will also have an asset that we'll report, and we'll report that in our inventory section of our balance sheet, saying that we actually think some of our inventory is coming back. Now, the inventory number's at cost, though, right? And the cost of goods sold number's at cost versus this number that's at retail. Okay? Now, what happens when somebody returns the goods? So it comes true. Somebody actually returns. What are they going to give us? They're going to give us the stuff back. What are we going to give them? We'll give them cash, right? So we'll credit cash. I don't know. I'm just making a number up here. Let's say 3,000 of stuff comes back. We debit cash and we credit what? Credit what? We credit what? We credit the what? Refund liability? I'm not credit it, debit it. The refund liability for 3,000? Because they're sending the money back to us, or they're sending the stuff back to us, we're sending them the goods back. Okay? Okay, good. So at the time of the sale, we take this account sales returns. That's on the income statement, isn't it? So it gets closed out at the end of the year. Okay, so the amount of the sales return contra to sales account, it's not an expense, but it's kind of like expense, happens what? Each period on the income statement? On the balance sheet, we have this liability, and it's somewhat of a moving target. We put amounts in there, we have the returns. Next year, we make more sales, put more in that liability as we make sales. As there are returns, we reduce it, right? And give them their cash back. And of course, you would have to also update the inventory account at that point in time by debiting regular inventory and crediting this what? Inventory return asset. Okay. Okay. All right. Let's go ahead and let's take a look at the allowance for doubtful accounts, estimating uncollectible receivables. Okay, and let's see how this works. Now, the way we're going to study these are as though they are two separate methods that never meet each other. That's the way we're going to first study them, and then that's sort of the way we showed you in Accounting 20, how that works, Business 20, the way it works. But we're going to see that actually a company would likely combine these two methods, taking a percentage of sales during the year and then at the end of the year making a year-end adjustment based on an aging, most likely, of the account receivable. Okay, but let's just first go ahead and study this percentage of sales method. Okay, and so this company estimates that 2% of its credit sales will not be collectible. So when it estimates that, it debits the bad debt expense for 2% of the credit sales, credits the allowance. Now when they do this, they pay no attention as to what the beginning balance was in the allowance. They simply add that amount on to the allowance. Okay, so we're sitting here and we've got our what? We've got our beginning balance. We've got our addition for the period based on the new credit sales, and we end up with the ending balance. Okay? Question? Okay, notice they didn't pay attention to what the balance was in the allowance account. Now, just to make sure we understand where the allowance account is showing up, so if we had in this example, say, accounts receivable of $250,000, just making that number up, then the allowance would have how much in it? 5,000. So we'd be reporting net accounts receivable in this example. What's that? 245,000 as our net accounts receivable, net of the allowance. Okay. All right. Now that's considered an income statement approach. That's the percentage of sales method. Okay. Now, you will see sometimes where we'll talk about using the aging of accounts receivable, which we're calling out as a balance sheet approach. Okay? When we do an aging, we decide how much to put in the allowance based on how many days past due these customers are. So if we have a customer that is what? Current, we might put a little bit in the allowance for them. If we have a customer that is way overdue, say 90 days, is starting to be a situation where we're starting to think it's more likely they're not going to pay us, we obviously will put what? More in the allowance for those customers, right? Now let's say we determine that after we do the aging, we need $1,600 in the allowance, but under the balance sheet approach, under the aging approach, we do consider the $1,000 that is already sitting in the allowance account. And so when we go ahead and make our journal entry for our bad debt expense, we'll do what? We'll debit bad debt expense and we will credit the allowance for the $600, which will bring it up to the $1,600 that we need it to be at this point. Okay. Now, they make an interesting point down here at the bottom. And they say if the allowance account, this is my allowance, and they tell us that it had a debit balance of $2,600, and we determined that we needed what? $600 in there, not a debit balance of $2,600, but a debit balance of $1,000, and we decided we need $600 in there. We'd have to credit it for what? $2,600, debit the bad debt expense for $2,600 so that now we have the desired $600 balance sitting there, credit balance. Okay, now how would the allowance had ended up with a $2,600 debit balance anyway? How would it have ended up with a $2,600 debit balance anyway? How would it have ended up with this $1,000, debit balance to begin with? Huh? Excuse me? How would it have ended up with a $1,000 balance? We credited for 26, so now the balance is what? But we only wanted 600 in there. So what should I have credited for? Not 2,600, but I want 600, so I should have credited for 1,600. 1,600. First off, let me fix that. Okay. If the $1,000 balance in the allowance account had been a debit, that's that, we would have added to the required ending balance. The entry would have been for, and I don't know why they're saying 2,600. It would have been for 1,600. That would have ended me up with what? Oh, all right. I want 1,600 in here, so I got it. So it would have been 2,600, and that would have given me the desired 1,600 balance. Right? Okay. But how does it, my question is, how does it end up with a $1,000 debit balance in it? Huh? Yeah, I guess, if you want to go nuclearly bad on it, you could say a bad estimate, but it happens, right? It's an estimation process. It's not perfect, right? Maybe we had in there a credit balance of 1,500 in the allowance. Okay, and then we have to write off what? 2,500? What are we going to do? We're going to debit the allowance for 2,500, credit the account receivable for the one we're writing off, or the several, doesn't have to be one, whatever. And when we do that, when we debit it for 2,500, now the balance is sitting there at what? At 1,000, right? Then we go ahead, good, and we do the adjustment. We say we need 16. We debit the bad debt expense for 26. We credit the allowance for 26. Now we've got the 16, right? Okay, so the allowance is a moving target, isn't it? It's not something that you can just sit there and say, oh, okay, now the allowance is perfect. Or should we ever have 0 in the allowance? Will there ever be world peace? No. As long as you have credit sales, there's going to be some people that unfortunately aren't going to be able to pay. The only way you get rid of the allowance, frankly, is to not have credit sales. Then you just take cash. There's no chance that somebody's not going to pay you because you make them pay you up front, right? Okay? Okay, good. Now you come over and you take a look at what we do when we recover a written off account receivable. When we do, notice we do what? When we have the write-off, as we've seen, we debit the allowance. Let's do that first. When you have the write-off, you debit the allowance and you credit the account receivable. That's when you have the write-off. Then what happens? Then debit the allowance, credit the account receivable. Then the person hits the lottery, and the first thing they do is want to come. The guy that won the $2 billion comes to you and says, "Well, let me give you the $100 I owe you anyway, right?" And so what happens? I heard somebody saying $2 billion, all that'll do is bring you trouble. Somebody was saying at the store in front of me the other day. I'm like, I'll take that trouble. So I'd probably can think right off the top of 10 people I'd give $1 million just not to talk to anymore. Okay. So anyway, okay. So what? $2 billion? Okay. So what happens? You sit here and you do what? You do this debit to the accounts receivable, credit the allowance when they come back, right? Thus putting the receivable back and putting the money back into the allowance. Now, sometimes students have trouble with that journal entry because they think, well, wait a minute, if you put the money back in the allowance, now the allowance has too much.
No, we put money in the allowance based on our experience of people who really don't pay us, not ones who fake not pay us, find the money, and then come and pay us later. Apparently, this was not the guy that we put the money in the allowance for, right? Because he ended up paying us. So we put that money back in the allowance, and then what? Then, of course, since they're paying us, we debit the cash and we credit the account receivable because they're paying us off now, right? Okay, so write it off. If it comes back, reestablish it, put the money back in the allowance, and then pay it off. Liquidate the receivable. Okay? Okay, good. Now remember, I said that the two methods are actually what? Actually together. What companies will do is they will typically take a provision during the year based on their sales. That's fine. Okay, we've already seen that that's the sales method where we just put amounts in the allowance and it doesn't matter what's in the account. We'll just sit there and put the amount in based on sales, right? Now, if I was auditing you and you sat there and you said, well, John, we put amount in the allowance and then we do nothing at the end of the year to see if we think the amount in the allowance is correct, I'd write you up with an audit finding. You always have to look back at what? At your account receivable balance, get a sense as to your collectability on that, and make an appropriate adjustment at year end. I don't care what you had put in there during the year. Okay, now sometimes you'll hear that, well, companies do this, and that must be because they've already determined that year to year their bad debts stay pretty much consistent from year to year, and so they just worry about whether or not their sales is a percentage of sales. Then they could go ahead and do that. But most companies are going to most likely do what? Do the aging to adjust the account receivable at the end of the year, whether or not they've taken amounts during the year. Okay, so let's just go ahead and take a look at this sort of little bit comprehensive example. And we've got this allowance for uncollectible accounts, and it's 1 here 5. It's $20,000. So I'm just going to go ahead and set up the allowance in a T account here. So my allowance, I don't know why they can't give me a palette of colors that I just dip in and out of. And so my allowance is 20,000, right? Okay. Now they tell me that I take a percentage of the credit sales during the year, 14,000. I debit the bad debt expense for 14,000, and I credit the allowance, right? For 14,000. Now when I credit the allowance, the balance goes up to what? 34,000? But then they tell me that I had write-offs of what? Of 12,500. So I debited the allowance and I credited the account receivable. Okay, so when I go ahead and I make that debit, the allowance account now has what? 21,500 sitting in there. Now I do an aging, and the aging now gives me information that I actually need what? I actually need 20,500. So I have too much in the allowance, don't I? I have too much in there. So to take some out, what am I going to do? I'm going to debit the allowance and I'm going to credit the bad debt expense. So if we were to tee up bad debt expense, I originally had debited it right there for what, 14? Now I'm crediting it for 1,000, so now the balance is what? 13,000. That's my bad debt expense for the year. It's 13,000. Okay, so you can make an adjustment up or down at year end depending, right? Can I have a negative bad debt expense? I could if I put what? Too much in prior years. Now let me tell you a story and ask you what you think about it. So we were auditing large banks. We were actually auditing my office. The GAO was auditing the Office of the Control of the Currency. OCC is an entity that audits all the large banks, Bank of America, Wells Fargo, etc. And so we're looking at the allowance. Congress wants us to look at the allowance because they want to see are banks correctly taking allowance for potential bad loans. Because if you have a bank that makes a lot of bad loans, it's going to do what? It's going to impact the bank's stability, and you're going to have a situation where all of a sudden you could have banks going under because they've underestimated their allowance for loan loss, made too many loans, and then who has to cover when banks go under? Federal government has to cover that, right? Okay, through the Deposit Insurance Corporation, Federal Deposit Insurance Corporation. So anyway, that's why they wanted us to look at it. So we look and we see that the banks are taking a lot of reserves. They're taking a lot of reserves. They're putting a lot of allowance for loan loss. And when you look at their overall process, they take some amounts based on homogeneous loans, which are like credit card loans. They take some amounts that are based on individual loans, like commercial real estate loans. They put those amounts in there for that. And then they would take another amount that they would call additional unallocated. And when they take additional unallocated, they wouldn't really put down what the purpose of that additional unallocated was. So when we asked them about it, why are you taking additional unallocated? It looks like you're taking a little extra. When we asked them about that, they said that they're putting amounts in for future loans. They said they're putting that amount in for future loans. Is that how you're supposed to do it? Why? Why not put amounts for future loans? You haven't made them yet. Sir, do you have a question or something? Do you have a question? We're putting amounts in for future loans, are we? Do we do that in accounting? Accounting is what? Based on a past transaction or event, isn't it? Okay? So what I'm going to ask you to do, I think, for our little research project is I'm going to ask you for a citation for that. I want you to give me a citation, and I'll give you some guidance on this later, but I'm just telling you now, while I've got your attention about this subject, I'm going to ask you to give me a citation. It's one thing for me to sit here and say, oh, you're not supposed to do that, but what does FASB say, right? I mean, the banks could have come back and said, well, that's what we're doing, we want to do it. So how do we know that they're only supposed to take loan losses for loans they have already made and not future loans? What citation will we be able to give them on that? Okay, and I'll give you some more guidance on that. I'll put it in writing, but I just want you to know that that's going to be the subject matter, what we're going to look for in our little research. Okay? Question? Okay, that's why I want to make sure nobody walked out of the room so that they wouldn't miss that story and miss that they're going to be doing some more work on that. Okay, all right, let's go ahead and let's take a look at pledging or assignment of our accounts receivable. So what happens here? Let's say I am short on cash. And I look and I see that I have this receivable balance that I'm going to collect on, but I look at the timing of it and I say, you know, the chances that I'm actually going to collect this cash in time to meet my bills and stuff is getting highly unlikely. I'm going to get short on cash. So I decide that I want to get some money for my receivable. Now, I can go ahead and go out and get a loan on my receivables. Okay, we call this pledging. I pledge my receivable as collateral against this borrowing. Okay, now if this is the case, okay, I use it as collateral for a loan. If this is a case, because I retain title to the receivable, I will leave the receivable on the books, and I will have to only provide a footnote disclosure that essentially saying there is what? There is a lien against my receivable. And people will be able to look at that and see that disclosure that there's a lien on my receivable. So it's a footnote disclosure only, right? Okay. Now, that is different than a factoring.
With a factoring of an account receivable, I need to look at that carefully, and I need to see if that factoring is with recourse or without recourse. Now, if it is without recourse, that means that the person that I have loaned that money to
Cannot come back on me in the event they can't collect on my receivable. They have no option to come back to me. That's without recourse.
If it is without recourse, then we treat that as a sale of that account receivable. We're going to show the sale. We're going to remove the receivable from the books, and we're going to record that sale as a gain or loss on the sale of the accounts receivable. Okay? If it is with recourse, we'll see in a minute, I'm going to have to look as to the nature of that recourse to determine if it is a sale. So it could either be a sale or borrowing, depending on whether or not I meet these criteria that you see down here. Okay? Now, let's just go ahead and see what happens when it is a without recourse. That means it is what? A sale. It means that the risk of loss goes to who? Goes to the purchaser of that account receivable. Okay, so it goes to the factor. That's the person that is buying that. Okay, there is no recourse, without recourse. Now, in this example, we don't have any numbers, but I'm going to go ahead and add some numbers to this. So say my accounts receivable, you might want to write these in. Say my accounts receivable equals 1,200. I factor it for 1,100. Why am I factoring it for less than the account receivable? Selling it for less than the account receivable?
Well, not for the uncollectible. The factor has to eat. I mean, they're not going to go around collecting on accounts receivable for free, are they? I mean, they want at least $100 out of the deal when they get done, right? So most I'm going to get out of this is 1,100, right?
Now, what you're thinking about for the uncollectible, we call that a factor margin. And say the factor margin equals 100.
So they're also going to hold back a little amount in case they can't collect.
So they give me cash up front of 1,000.
So he gives me cash up front of 1,000. I surrender my
$1,200 account receivable. I know I'm only going to get 1,100 at the most out of this, so I'm hoping I get this factor margin back of 100 in case to see if they can collect or not. Okay? So what happens? I get cash of how much? How much cash do I get? 1,000 up front. Good. Then what? I'm going to hope that I get this factor margin back of
$100 that's due from factor.
Okay. I'm going to go ahead and credit my account receivable for the full 1,200. I'm selling those off to him. I'll never see him again.
I'll never see the receivables again. I can't come to the receivables.
No, I missed them. Give them back to me. They're gone, right? He takes them. And then I have this loss, and I know already my loss is what?
$100. That's the 1,200 minus the 1,100.
Now, if he says, hey, those were good receivables I collected from everybody, what am I going to do? I'll debit cash for 100, and I'll credit due from factor. Because he's paid me
The remaining 100. If the guy turns around, right?
Oh, sorry. Thank you. You're looking at it like, where did it go?
Okay. Debit
Cash credit due from factor for the $100. Okay.
Now, if the guy says, you bum, I couldn't collect on all those. I say, ha ha, ha ha, too bad. They have no recourse on me, but they're not going to give me the $100 margin, right?
And so what will I do? I'll go ahead and I'll still credit due from factor. I'll write it over here. That says due from factor. I'll still credit that for 100, but now I'm going to debit what? Loss. Good, for 100. So my total loss is 200 now, isn't it? The original 100 plus this additional 100 that they didn't pay me. Right? Okay. Okay, good. Now we come over. If you think, by not acknowledging that you understand, you're hurting me, you're not. You're hurting yourself because it causes me to stop and say, right, right, right. And that's when we end up taking less time. So if you understand it, go, oh. If you don't understand, go, so I know what's going on. Okay. All right. Okay, so we're good here? Okay. No, you're supposed to go, no, I'm just kidding. Okay. So what happens now? You come over, and of course we said that it could be with recourse. Now, if it's with recourse, notice I said that it could be a sale or it could be what? Borrowing. So we need to look at what the nature of the recourse is. Okay, so in order to be considered a a sale, it has to meet all of these conditions down here. And it is what? The transfer obligation for uncollectible accounts can be reasonably estimated. That would be me. I'd be the transfer. I have to figure out what the amount is that's going to be not collectible. I have to be able to estimate that. I have to surrender control of the receivables. I can't be sitting here saying, gee, I got an option of taking them back from you at some point in time. And if the person cannot collect, the transfer, the person that's giving them over to the factor, cannot be required to give them their money back. I merely would have to be required, their recourse would be that I have to be required to replace the receivables they couldn't collect on with similar receivables. So if we're sitting here and, you've got these receivables that I factor to you, you give me the money, and you go ahead and you try to collect those. Take the three, take this one, and this one. Okay, you take those and you try to collect on them, and let's say you couldn't collect on the yellow one. Give me the yellow one back. I take the yellow one and I say, here's a similar receivable. Go ahead and try to collect on that one. So I replace it with a similar receivable, right? Now what happens if you can't collect the green? Give me the green back. You give me the green, I go ahead and I replace it with a similar one, right? And we keep doing this till you finally get all of your money back. That's the recourse. Yes, sir.
You as the company take the one that they couldn't collect back?
As the person that had originally transferred it,
You get it back, so you could then collect on that potentially.
potentially I could, or I might have to write it off. But the recourse can't be that I got to give you your money back, that I get your cash back. If it is, it's not a sale, because I'm having to give the money back to you.
One way I'm going to give you more receivables. It's kind of like for time swap.
We're doing one, I'm giving you till you're satisfied. Your recourse is you can come back and ask for other receivables. The recourse can't be that you want your money back. If you want your money back, it's a collateralized borrowing. Okay, it's just like the pledging that we saw up here. If any one of those criteria are not met, then it is simply treated as a loan. In other words, it is what? Collateralized borrowing. It is a pledging if you don't meet all of those criteria. Okay? Question? So if I have to give you your money back, it's not a sale. I mean, that's always the case. If you could come back to me anytime and say, give me my money back, we're going to have to reduce the sale for that, right? Like the right of return thing, same sort of general principle. Okay? Okay, good. Now you come over and we talk about our notes receivable. And if we have notes receivable, we will go ahead and value those. And when we value our note receivable, they need to be shown at their present value. They need to be shown at present value. Okay, we'll talk about that a little bit more here, what we mean by the present value, but we need to look at the cash collections and discount them to their present value. And the difference between the face of the note and the present value will be called out as a discount. And we'll talk a little bit more about that. But let's talk about discounting of note receivable. And discounting of note receivable is like selling of the account receivable, and it can be with recourse or without recourse. Now, if it is with recourse, then I'm going to do what? I'm going to still show the note receivable, and then I'll have a contra account against that indicating that it has been discounted to a third party. So the net will be what? 0 on that, right? Here's the note receivable 100,000, but I've done what? I have discounted it without recourse, so it's gone, isn't it? So I'll subtract it at the same time, so it'll come out to 0. Or they tell us, and I think this would be the more obvious, probably the more preferable approach for most companies, would be to simply remove the note receivable from the balance sheet and then just footnote that there's been this with recourse discounting of the note. Now, if it's without recourse, what? You can't come back to me. It's a pure sale. Okay? But what we need to do is figure out what is the amount that will come in on this without recourse sale of the note. Okay? We call that discounting of a note. Okay? And we typically will discount the note to a bank. So what will happen? We've got this note, and we get tired of waiting for our money. Now, when I say get tired, I don't mean get tired in the sense of, geez, I'm really bored. I wish they'd send me the money. I mean, we get tired that we probably need the money, don't we? Okay? And so what happens? In this example, we had this 40,000 90-day note from a customer dated September 30th, year 3, due December 30th, year 3, and bearing interest at 12%. On October 30th, that's 1 month after issue, they get tired of waiting for their money. It doesn't say that. But they take the bank to the note, which is willing to discount it at a 15% rate. And so the bank is essentially giving us the money 60 days early, aren't they? Okay? So these are some nice steps to follow here. This is how you would do this. Step 1 is to go ahead and figure out, well, how much money would I have received on maturity? So I take the 40,000 times the interest rate on this, 12%, times what? 90, 360ths, and we use a 360-day year in accounting, and you say, we do? Really? When? Well, look. Don't you take your depreciation expense and divide it by 12 to come up with the monthly depreciation? Well, you're assuming in that case that every month has what? 30 days, doesn't it? Okay, so we pretty much assume a 360-day year in accounting for these purposes. And so you go ahead and you get this $1,200 interest we would have earned. And so if we had just been able to wait to maturity, we would have got our $40,000 principal back, plus this $1,200 interest, we would have got the $41,200, right? Okay. Then what? Then we go ahead and we figure out the interest that the bank is going to charge us for giving us that money 60 days early, right? It was a 90-day note. We still have 60 days to go until it'll actually mature. So the interest from the bank is $1,030. So we would have gotten what? $1,200. We take off the bank's discount on that, which is the interest they're charging to give us the money 60 days early. And so the bank is going to give us what? $40,170 on that. And since we originally loaned 40, we made only interest of what? 170. And you'll see questions in the quiz that we'll probably get to next time. We'll definitely get to next time. We won't get to today, where I'll show you how we make those calculations. Okay? In fact, yeah, let's do a couple questions right now, and then we'll stop. And we're going to talk about what we're going to do with the quiz. But let's go ahead and let's see if we can work the question right here. If I can get this to... No, okay, we're going to just have to deal with that size up there. So Roth Inc., let's do this question right here. Roth Inc. sat here and received a $500,000 note bearing annual interest of 8%. So it's $500,000. And if they waited till maturity, they'd get interest of what? 40,000 on that? So the total amount that they would have gotten if they waited is what? 540? Of course, they're going to get their principal back, right? They would have got 540 if they could have waited. Okay. Now, after holding the note for 6 months, Ross discounted the note at a regional bank at an effective rate of 10%. Okay, so if we have a 10%, then they're going to sit there and charge me what? 10% interest on that? 0.10, but we're getting the money 6 months early, aren't we? Because we had waited for 6 months. So we have to multiply that times 1/2. Okay, and when we do, I think we get 27,000. Okay. Now this question asked a little different question than what we saw in the little example we just went through. They want to see what the proceeds are that we're going to get, and the answer is going to be what? 540 minus the $27,000 interest the bank's going to charge me. So the bank's going to hand me a check for what? 513,000? And I would make interest income of 13,000 if they had asked me that, like that other question did. 500,000 minus what? I'm sorry?
No, she thought that you were supposed to add the 40,000 instead of, subtract it. Yeah. She just got confused.
Okay. We're good now. I'm still not sure what the question was, but okay. Okay. I'm not sure where 60,000 came from, but anyway. Okay, so that's that one. Okay, let's look at this first one here now. And they tell me that they have this jamming company, and it had a credit balance of 280,000 in its allowance at January 1st, year 4. Okay, so if it was 260,000, that's the beginning balance. And the allowance, I guess we're going to analyze the allowance here. 260,000. Right? And then they tell me that past experience, 2% of Jammin's credit sales have been uncollectible. During the year, they wrote off what? 325. So I'm just going to go in. I'm going to put in my subtract here. My subtract is the write-off, isn't it? Which is 325. Okay, and then they tell me that they had credit sales of 9 million. Okay, beautiful. If we had credit sales of 9 million and they tell me that 2% of my credit sales will be uncollectible, then that must mean that I need to add in 180,000. So if you do the math on this, they want the ending balance. This was kind of an easy question because some questions will ask you what's the beginning balance, or they'll ask you what's the expense for the period. So you're going to have to work backwards to get to it. But this one was pretty easy. That means the ending balance is what? 260 plus 180 minus 325 is how much? 115. Okay. Okay, good. So we're going to stop there in terms of the slides. We'll finish the back end of those, and we'll finish the quiz next time. Yes, sir. Yes. But before we get out of here, hang on a minute, guys. What do you want me to do? Don't I have to end it first? And then say keep? Okay, and then say save? Let me just say, label it as markup. Hang on, guys, we got 4 minutes. Thank you, sir. Okay, so the question here is, what are we going to do? How many people want to move the midterm, what do we say, to the 14th? Okay, okay, that's not enough. So we're going to keep it on the 17th then? I mean, it needs to be an overwhelming, the 7th? How many want on the 7th? Okay, let's try this again. Who wants it on the 14th, after Veterans Day? Okay. All right, so that's overwhelming amount, so we're going to have to put it on the 14th. For people that are going to miss the 14th, if it's one or two people, see me and I'll try to work something out for you since we did change the date on you. I typically don't change the exams, but since I've got just a handful of people, we did change it. I'll work something out for you as best I can. Not that you'll get to take it. Not that you'll get to take it on the 7th, but you'll get a chance to take it somewhere around the 14th. Okay? Okay, so the exam's on the 14th, and it's going to cover, obviously, Chapter 5, 7, and with some luck, we'll be able to get 8 in there. With some luck, we'll be able to get 9 in there. Okay? So definitely 5, 7, and 8. Okay, guys. Yeah, for